This is FRM Part 1, Book 3, Financial Markets and Properties of Stock Options. And this is really a natural extension of what we talked about back in Chapter 11. But it's really a great preview of what we're going to talk about many chapters ahead when I introduce the Black-Scholes-Merton option pricing model. And we're going to take some of these really important variables and try to price a call option. And then by implication, we can also price a put option. So let's look at the learning objectives here. Today, we're going to talk about these 6 factors that affect an option's price. But we're also going to talk about this really cool thing called put-call parity. Now, remember from your economics days, parity is a term that implies some kind of economic equilibrium. In this case, put prices have to be related to call prices, and then we're going to throw some other markets in there. And I promise you're going to love that put-call parity. We'll also talk about a little bit about the differences between European and American options. So let's go ahead and begin by having a discussion on these 6 factors that affect option price. Let's go ahead and just take an example. Let's suppose that we have a call option and a put option, both of which have exercise prices of 100, and these are written on a share of stock that is currently trading at 100. You remember from last chapter, we would call that an at-the-money option, when the exercise price and the stock price are the same number. All right, so let's look at these 6 factors. We have 3 of them on this slide. Let's begin with a call option. What are we doing with a call option? We're betting that the price of the underlying share of stock goes up, right? So that if we're right and the price of the underlying share of stock goes up, then of course the value of the call increases, right? So that should make perfect sense. With the put option, it's just the opposite. So we're of course betting that the price of the underlying stock goes down, and if it does go down, then we have to win, right? So there is a direct relationship between the stock price and the call price, and an indirect relationship between the stock price and the put price. Now, remember what I said in the previous chapter is that the writers of these options are typically financial institutions. And of course, they write options all the time. But if you're a wealthy investor, you can go to the financial institution and say, hey, I would like a particular option written at this particular exercise price. And so let's just take a look at a call option first. If you go in and say, hey, I want a call option on this share of stock that's trading at $100 and the exercise price is $100, well, the financial institution will charge you some number. Let's say it's $5 for the price of that option. But if you go in and say, well, wait a minute, I want the right but not the obligation to buy at just $80 rather than the $100. Well, the financial institution is going to say, well, of course I'll write that option for you, but it's going to cost you more. So look at my 2 circle points there under 2. For call options, the value decreases as the stock price increases. For put options, the value increases as the stock price increases, and that should make perfect sense for the put option as well. If you go in there and say, hey, I want the right but not the obligation to sell at, let's say, $5,000 when the stock is trading at 100, well, then the financial institution is going to say, wow, you want the right to sell at these thousands of dollars when the stock is only trading at 100. Boy, you better pay us a lot of money today. Time to expiration, this factor is very intuitive, right? I mean, the longer the time to expiration on the option, the higher is the chance that the option will finish in the money. Of course, because remember, what do stock prices do? They go like this. And for the call option, you want that expiration date price to be way up here. For the put option, you want it to be way down there, right? So with timed expiration, you have a longer time period to get the kind of spike or dip that you want. How about the short-term risk-free rate of interest? This is not quite as intuitive as maybe the first 3 were, but let me go ahead and explain this to you. Let's suppose we have this We have this call option. Exercise price is 100, stock price is 100. Financial institution might charge you $5 for that at the money option. And by the way, we're going to do so many cool things with this Black-Scholes-Merton option pricing model. Let's just suppose that that model comes up with that $5 price. Now here's the deal. If you want to buy that share of stock, you have to go to the New York Stock Exchange and pay $100, right? But if you buy the option, all you're out is $5. So you have $95 to invest. So you could take that $95 and go invest it in the risk-free asset. Now, you ready for this? If that risk-free rate of interest is upticking, if it's increasing over time, you're going to prefer buying that call option rather than buying the share of stock, because the future value of your $95 is going to be greater. So you're going to put more demand in the options market. So as the risk-free rate increases, the value of the call increases, but conversely the value of the put decreases for the same but yet opposite reason. How about this fifth factor, dividends? Remember that if you own the share of stock and the company pays a dividend, you have every right to receive that dividend and expect to receive that dividend, and you can cash that dividend check and go out and buy something with it. But if you own the call option, you don't receive that dividend. And so as the dividend yield increases, then the value of that call decreases. And of course, just the opposite happens for the put option. And so that's what I have on the second circle point. Call option holder has no access to the dividends because they do not own the underlying stock. But then, of course, we have this whole process of stock pricing on the ex-dividend date when the shares start to trade ex-dividend, and it falls by the amount of the dividend. Now, the sixth factor is by far the coolest of all of these factors. The sixth factor is sound like a Bruce Willis movie. Let's go ahead and take an example. Let's suppose that we're considering buying an option on a utility stock like a water company. And what do we know about water company prices over time? They probably go like this. They fluctuate, but they go like this. Maybe they go a little bit like that, right? And why do utility company stock prices appear to be stable over time? Well, it's because the federal government is, pretty, and the state government are pretty influential in the pricing. They determine rates and they determine capacity and they determine all this. And of course, the other side of that is that, with a water company, the growth rate is not too substantial because it's not like, here I am, Jim, I'm a consumer of water, and this week I take 1 bath a day, and next week I say, I want to be really clean, so I'm going to take 2 baths a day, and then 3 baths a day. So, consumers have pretty much a standard number of baths that they take a day. So the growth is not that great. So stock prices for water companies are going to go like that. Well, how valuable is that option if you don't have too much of a chance? You're never going to have a chance of a big spike, right? Or a big dip if you have the put option. But take a tech stock or an internet stock or some volatile stock that goes like this and like this and like this. So here's the cool thing about this. Volatility increase, the value of the call option and the value of the put option is going to increase. And all that means is that there's a greater chance that the option will finish in the money. Now here's I'm sorry, I went ahead one too many. Here's a slide for notation. Lowercase is the European option, uppercase is the American option. Of course, the big difference here is that the European option, both the call and the put, can only be exercised on the expiration date. An American option, both the call and the put, can be exercised at any time between the purchase of the option and the actual expiration date. Now, at some point in the future, I'm going to convince you that investors and owners of call and put options are probably not ever going to exercise their option early, even though they can. They're probably not going to exercise their option early because options have time value. And I will show you that in the Black-Scholes-Merton option pricing model at some later video. Now, that doesn't mean that you're not going to sell your option, of course. traders of options, they want to buy low and sell high, and they can do that at any time. And so here are some pricing bounds for the options. So the value of a call option is always going to be less than the value of the stock. And that should make perfect sense. That you would never pay $120 for a call option that gives you the right but not the obligation to buy a share of stock for $100. That doesn't make any sense, right? And then, of course, the same thing is true for the put options, and it's just the opposite. Let's move into put-call parity here. So this is what we're doing. What we're saying is that there has to be a parity condition inside of the call market, inside of the put market, but also as it relates to what's going on on the floor of the New York Stock Exchange and what's going on in the bond market. All right, so let's look at this put-call parity formula. There it is mathematically. The C stands for the call premium. The P stands for the put premium, and notice that they're on kind of opposite sides. The S stands for the stock price. So in this particular version of put-call parity, we're assuming that the call and the put are written on a share of stock, and the call and the put are written on that share of stock, and they both have to have the same exercise price. All right, so there's K, and that is the strike or the exercise price of the option. And of course, when are we going to either buy or sell that share of stock inside of the option market, whether it's a call or a put? We're going to do it at some time in the future, right, on the expiration date. So if we're pricing these things today, we have to take the present value, and we're going to assume continuous compounding. So we use our little e to the x button on the calculator, and that's why we have a minus sign in front of the risk-free rate times time to indicate present value. So the put-call parity formula looks like this. The call plus the present value of the exercise price has to be equal to the stock price plus the put price. Now, what I could do next is I could put a bunch of numbers up there and kind of prove to you that that works, but I want to take a different tact here. What I want to do is the following. Let's go up to that top block point. On the expiration date of these options, the put-call parity looks like that. Now, let me swing back over here. What I want to do is tell you guys this, that this formula here is taken right out of the source material. What I have done, and this is before expiration, what I have done is I've switched it around to kind of help you guys memorize this formula for any exam that you might have to take. Look at the left side of the equal sign, S plus P, S and P. So this is how I remembered it way back in my studying days. I always started with put-call parity as S and P, so stock plus the put, and that has to equal the call plus the exercise price. And what I'm doing here is this is the expiration date of both of those options, so we don't need to worry about the present value. So notice really the only difference between that formula at the top of the page and this formula here is the present value of the exercise price. All right. Now, this is what I want you to do. Let's forget about put-call parity here for just a second, and I want you to think about owning a portfolio. And we're going to do two of these here, but the top table is a portfolio in which you buy the stock for $100 today, and you buy the put option today with an exercise price of $90 a share. All right, so you own the stock, S, and you own the put option, P. So that's the S and P. All right, let's forget about how much the put option costs. What we're doing is we're looking at what are the values of each of these two assets in the portfolio, and then what is the portfolio worth. So at expiration, right, what do we know? That the stock price at expiration could be almost any number. What I have done is picked 4 discrete intervals. I've picked 80, 89, 110, and 130, but I could have picked any numbers. I could have picked 41 and 82 and all those numbers. But note that some of them are less than the exercise price and some of them are greater than the exercise price. All right, now let's look at that first line. This is not a trick question. On the expiration date, what is the value of the stock if it trades at $80? Well, it's $80, right? If it trades at 89, then it's 89. So that first row of the value of the stock, that's not really very exciting or challenging mathematically, right? The value of the stock on the expiration date will be, well, whatever it's trading for. All right, but the next row, this is the put option, right? So we have the right but not the obligation to sell at 90 when the stock is trading at $80. So the put option has an intrinsic value. Remember, there's no time value at expiration. It has an intrinsic value of $10. So your stock has fallen in value, right, from 100 down to 80, but your put option has increased your portfolio by $10. So your portfolio is now worth 90. Let's skip over to the next column. Suppose the stock price at expiration is $89. Well, there's the stock. It's worth $89. And how about the put? You have the right to sell at 90 when it's only trading at 89, so that put is worth 1. 89 plus 1 is 90. Now, before we move over to the 110 and the 130, notice I said a few minutes ago that I could have put any numbers there in those first two columns. I could have put 71 and 31 and 59 and 82, but what if they would have summed to? No matter what happens, the fall in the stock price from 100 down to whatever that price is would have been exactly offset by the gain in the put market. So all of those values are going to be 90. That's why if you own the stock and you own the put option, they call it a protective put. So that $90 is kind of a floor value of this two-asset portfolio. But then what happens when stock price rises? If it goes up to 110 or 130, then the stock price is 110 or 130, right? But the put option will be allowed to expire worthless, right? Why would you exercise your option to sell at 90 when you could sell at 110 or 130? So I have a 0 next to those put options. And there's the value of your portfolio. It's the value of the stock, 110 and 130, because the option is worthless. So I want you to imagine an Excel spreadsheet where we have bunches of numbers from 90 all the way down to 0. Well, those portfolio values are always going to be 90. And then imagine a bunch of them from 90 all the way up to 10,000 or whatever a big number is. We're going to have a linear thing that goes up like that, right? So it increases with the value of the stock. All right, take a deep breath now. Let's forget about that portfolio and let's do something else. Let's suppose we have a different portfolio in which we own the call option that has an exercise price of 90 and we own a bond that matures for $90. And let's put a comma there. This is going to be a risk-free bond so that there is no uncertainty about that $90 receipt at maturity date of the bond. And just for simplicity's sake, let's suppose this is a 0 coupon bond. So in between all this stuff, we don't have to worry about any coupons being paid. Okay? So we have two assets now. We have the call option and we have a risk-free 0 coupon bond. Make sense? All right, so I'm going to do those same possible stock prices at expiration, the 80, the 89, the 110, and the 130. And I'm going to ask the question now, what is the value of the call option? Here we have the right but not the obligation to buy at 90 when the stock is trading at 80. Well, why on earth would we do that? We would go to the New York Stock Exchange and buy for its current price of 80. So the call option expires worthless, right? But the bond matures for $90. So if you add the 0 and the 90, what do you get? You get a portfolio value of 90. How about if the stock price goes up to $89? Well, the call option is still worthless, right? You still allow it to expire. The bond is still worth 90. The bond is always going to be worth 90 at the maturity date of the bond because it is risk-free, so your portfolio is $90. So imagine an Excel spreadsheet going from 90 all the way down to 0. What happens? Call option is worthless, bond is $90, right? So you have $90. So you have that same line there. But now, here's where it gets a little bit more interesting. What happens if the stock price is 110 or 130? Well, now the bond is still going to be worth 90, right? The bond is always going to be worth 90, but now we have the right to buy at 90 when the stock is trading at 110. That has an intrinsic value of $20, right? So you take the 20 and you add the 90, you get the 110. When the stock is trading at 130, you take the 40, add it to the 90, and you get the 130. All right. Now, why did I go through all this stuff? I got two tables here, but the cool thing is the bottom. What do we have at the top? We have the S&P, right? And in the bottom, we have the C plus the K. Well, notice that no matter what the stock price is, whether the stock price is $2 or $8, or the stock price is $75 or $83, or the stock price is way, way out here, can you see my hand? Or it's $200 or $250. What's going to happen? Those two portfolios are going to have the same payoffs. They're going to have the same future values. So what does that mean? If they have the same future values, then they ought to have the same present values. So this is put-call parity, and there's the formula that I have at the very bottom of the page, which is identical to what we have on the previous page. So remember, put-call parity, S&P, and then you do the call plus the present value of the bond. And remember now, the cool thing here, the cool financial engineering or financial innovation or financial thought process is that you're going to buy a bond that has the same exercise price, that has a maturity value as the exercise price of the bond. And in this case, it was 90. And don't be too upset and say something like, "Hey, Jim, there are no bonds out there that mature for $90. Well, don't worry about that. I could have easily put a bond in there that matures for $1,000 or $10,000 or $100,000. And so the math works. So there's put-call parity. And what does that tell us? Oh my gosh, this is so cool. You ready? That the stock and the put have to be equal. That's an equal sign. Remember what you learned back in kindergarten. The equals means that what's on the left is the same thing that's on the right. Has to be equal to the call plus the present value of the exercise price or the present value of that risk-free bond. Now, what that means is that you can rearrange that formula. So let's go ahead and do this visually. Ready? Let's subtract P from both sides. So the stock price has to be equal to the call price plus the present value of the exercise price minus the put. So here's the thing. If you don't like the stock price from the New York Stock Exchange on the left-hand side of the equal sign, then you can replicate it by going to the put market, to the call market, and to the treasury market. Oh my gosh, this is put-call parity. It tells us that there's equilibrium in the equity markets and the options market and the risk-free fixed income markets. All of these markets are interrelated and integrated. There are lots and lots of arbitrage opportunities if that equality doesn't hold. We'll talk about that in just a second. So here's what the source material wants you to be able to do. They want you to be able to take some of these inputs. All right, so look, let me just go back here. You have four, right? You have four variables in here. How about if you're given three and you can solve for the fourth one? So really all you're doing is some simple algebra. So that's what we have here. Stock currently sells for 51, 3-month call option, price of 5, strike price of 50, risk-free rate is 10%. Determine the price of the associated put option. So remember, that term associated put option means that A, it's 3 months, and B, it has the same strike price of $50. So there's the formula, and we just rearranged the formula to solve for the put price, and we just do the inputs, and we get $2.77. Now, take a deep breath and ask ourselves the question, let's suppose that the put over on the put market is not $2.77. Suppose it's something different. Well, there's going to be arbitrage if we believe in put-call parity. And we ought to believe in put-call parity. I mean, it doesn't work perfectly because there's all sorts of transaction costs out there. But it works fairly well. Where am I here? All right, so let's quickly work through this example. If the put is trading for $3, right, that means it's greater than the $2.77, then you can do the following. You can buy the call for 5. You can short the put and get the 350, right? You can short the stock to get the 51, right? And then you can invest the $49.50 for 3 months, making $50.75. which is going to be the future value of that $49, right? We're just compounding it out continuously. And so you're going to make 75 cents no matter what happens. So if the stock price is greater than 50 or the stock price is less than 50 at expiration, then you have these payoffs there. And notice at the bottom, that bottom circle point, the net profit is 75 cents. So there's that arbitrage opportunity. What is it? You take no risk and you have no investment and you expect a positive return. And there's your net profit. So that's 75 cents for every, what is that number up there? $49.50 that you can invest. Now that put call parity works much better and was designed originally for those European options because it avoids the possibility of early exercise. But if you can exercise early, the relationship turns into this following formula there. So look on the left-hand side there, you have the stock price minus the exercise price. And then look way on the right-hand side, you have the stock price minus the present value of the exercise price. So this equality has to hold true. C minus P, the call is always going to be greater than the put. Now here's just a small slide about the effects of dividends. When a stock pays a dividend, its value must decrease by the amount of the dividend. And what this does is it increases the value of the put and it decreases the value of the call. And so those minimum values look like they do in the table there. So the maximum value of the call is the stock price and the maximum value of the put is the exercise price. And then the minimum values are going to be zero. Of course, zero, right? The option is never going to sell for less, for a negative amount. I mean, how crazy would that be if you showed up some market and you sold it for a negative amount? You know, that's like going to Walmart and having Sam Walton say, "Hey, here's a vacuum cleaner. I'll pay you $500 for it." So that's probably a good table to memorize. And that takes us through chapter 12. Next up, we'll talk about some trading strategies.